Hey everyone, welcome to part 3 of the ultimate guide to building wealth and passive income in real estate. In part 1, we talked about the overview strategy, a strategy that I called the slow flip strategy. It's a variation of the BRRRR strategy, BRRRR standing for buy, rehab, rent, refinance, repeat. My little twist being sell. The selling component for your lowest performing properties over a period of time will allow you to actually exponentially grow your portfolio versus just buying them on a linear basis and not selling anything and just kind of keeping everything that you buy. So that was part 1, the overview. Part 2 was some case studies showing how we bought some properties utilizing this strategy and what those numbers looked like. Now we're in part 3. We're going to go over a plan of action. It's a very simple plan of action. Anyone can do it, part-time, full-time. Whether you're new or you're very experienced, this is a very simple plan. We're going to show you from the simplest version all the way to, if you want to be a little bit more aggressive with it, what it looks like. We do have to have a few assumptions. So in this plan of action, we're going to assume properties $150,000, the loan amount being 75% of that value, the ARV after repair value, so $112,500, rent being 1% of the value, $1,500, PITI $1,112. This represents 6% for a 30-year mortgage. Depending on the loan products you're using, you probably get a much better interest rate than that. But 6%, 30-year, if you're getting non-QM investor financing, that's actually a pretty good rate. Reserves, $150 a month. That represents 10% of your monthly rent. This helps cover vacancy and capital expenditures, because even if you don't have any up front, you eventually will have some. You can't argue it. It's absolutely going to happen at some point. And in the event, say you didn't have any while the tenant was there, well, when they move out, you're going to have some make ready. Depending on how long they were there, maybe a large make ready. And then finally, net cash flow, $238 after all the above have been taken out. It's not a lot of money, but it compounds over time. So we're going to look at this, how this stretches out over a 10-year period. And then we're going to look at the same numbers, but we're actually going to factor in a little bit of aggressiveness and see if you want to get aggressive with this, what it can actually look like. I think you're going to be really surprised. So year 1, and here's what we're going to do. We're going to start out with, you're buying 1 property a year. Anyone can do that. Doesn't matter how inexperienced or whether you're just part-time. Anyone can buy 1 rental property a year. So we're going to start out with that. So year 1, you got $238 in cash flow. Your equity, $37,500. Year 2, everything doubles. $476 in cash flow a month, $75,000 in equity. Year 3, $714 cash flow, equity $112,000. Year 4, almost $1,000 a month now, $150,000 in equity. Finally, in year 5, we broke 1,000. We're now at $1,190 a monthly cash flow, $187,500 in equity. Year 6, year 7, year 8. Now we're almost $2,000 a month, but we have $300,000 in equity. Year 9, here we are, year 10, $2,380 a month in cash flow, $375,000 in equity. I get that $2,300 a month, it's not like life-changing money, but for a lot of families out there, that's pretty good. That's pretty good, and that can actually change their whole financial well-being. But that $375,000 in equity, here's the thing. With both of these numbers, it's actually bigger. It's actually bigger because remember, we left out some things. We left out appreciation and debt pay down. So if you do this right here, you're already a millionaire. All you have to do is pay down the properties. Let the tenants pay down the properties. So in this example, pay it all down, assuming no appreciation at all, which properties over time almost always appreciate. But if you look at it that if they didn't at all, then you're worth $1.5 million. That's your equity once you pay them all off. That is great. You're a multimillionaire if you can pull this off. It's simple, 1 property a year, do it for 10 years. But you factor in appreciation and the debt pay down, your equity after this 10-year period is much higher than the $375,000. So congrats, do this, you're a millionaire. But what happens if you use what I call the slow flip strategy? This is how this formula works. So We talked about the BRRRR strategy: buy, rehab, rent, refinance, repeat. But what we're going to do in the 10-year period, we're actually going to sell some properties. So in this example, we're buying one property a year. That has not changed. So over a 10-year period, you have 10 properties. But starting in year 6, you're going to sell off one of your properties. So in year 6, one of the properties, probably your lowest performing one, is going to be sold, and you're going to take that equity and buy 2 more. Very simple. You're going to take that equity and buy 2 more rental properties. So therefore, you're turning one property into 2. So you bought 10 original. You sold 5 of them because you sold one in year 6, 1, 7, 8, 9, 10. But every time you sold one, you bought 2 more. So you basically sold 5, you bought 10. So now you have a total of 15 properties in your portfolio, giving you a cash flow of $35.70 a month, equity $565,500, and you haven't done much more work than you did just to buy the original 10. But this is only if you buy one property a year. So if you buy one property a year using, and you don't use the slope flip strategy, you're a multimillionaire. If you buy one property a year using the slope flip strategy, you're now, almost any way you look at it, probably a multimillionaire. But what if you buy 2 properties a year? In the event you buy 2 properties a year, that's 20 properties over a 10-year period. But in the slope flip strategy, starting in year 6, you start to sell off not 1 this time, but 2 of your worst performing ones. And you use the equity from those to double them. So as opposed to buying 2 more, you sell 2, but you're actually going to be buying 4 more. So in year 6, 7, 8, 9, 10, you will have bought 20. So now you have a total of 30 properties in your portfolio, giving you a cash flow of $7,140 every single month and an equity of $1.125 million. And remember, with appreciation factored in and debt pay down, you're actually worth much more than that. Pay them off significantly more than that, you're a multimillionaire. This is buying 2 properties a year and then just starting to reinvest or recycle some of those lower performing properties in year 6. Let's go one more step. Buy 3 properties a year. This may seem crazy, especially if you're brand new, but again, anyone can do this. It's very simple. It just takes getting started. Buy 3 properties a year. For 10 years, you get 30. But starting in year 6, that's when you start selling them. Not 1, not 2 this time, but 3 worst performing properties. So years 6 through 10, you sell off 15. Each time you do that, you take those 3 properties and you reinvest them and buy 6 more. So you actually bought 30 new properties in addition to the 30 original. So you bought 30 original, sold 15 of them. You turn that 15 into 30. So now you have a portfolio of 45 properties total. This gives you a cash flow of $10,710 every single month. That is life-changing money for pretty much any family out there. That's life-changing money, knowing that is coming in every single month. Equity at $1.687 million. Paid these things off just significantly more than that. This is absolutely life-changing. And again, it's more than that because of appreciation. Of course, I mentioned the debt pay down. So there are a few key points with this strategy. Not everything has to be a flat plan like buying 1 a year. I mean, maybe you start off buying 1 a year, but in year 3, you end up buying 2. Or year 7, you start buying 2 or 3 a year. You can do this at any point. It doesn't have to be that rigid. But when you're buying them, it's important to buy like a flipper. Buy that. I mean, buy them at a discount. You have to get them at a good discount to allow the properties to cash flow and to give yourself the equity needed for flexibility, for cash flow, and also their investments. You need to protect your investment, and that's ultimately why we're buying these things, to build wealth. You have to manage them like a professional. This is the biggest takeaway of any of these key points: is you have to manage them like a professional, which means if you're going to self-manage them, you need to actually manage them. Some of the best deals we get are from landlords that they're just bad landlords. Now, a lot of them, they stumbled upon being a landlord. They inherited the house, or they moved, couldn't sell it, so they had to rent it out, and they just never really did a job managing the tenants or screening them when they got in. So unfortunately, it depreciates their asset. So if you're going to manage yourself, you need to manage professionally. You need to be screening the tenants, taking proper deposits, setting rent to market rent and managing their payments on time, managing their late fees if necessary, and taking care of reasonable repair requests as per law and the lease. And of course, building out the functions that you're going to need to manage the properties. Or just do what I recommend, hire a property manager. Being a landlord is great from the cash flow and wealth building perspective, but being a landlord from a actual work and handling HVAC requests on a Friday afternoon or a plumbing request on a weekend, that's not entirely fun to me. So you can hire a property manager, and there are a lot of them out there now that'll do it for a flat fee, usually around $100, give or take or so. It depends on your marketplace, but roughly around $100 regardless of the rent amount. And they're full service property management companies. So get referrals in your area and check on that, because if you have a full-time job, managing rental properties on the side may not be the best idea. Again, I kind of recommend just going with a property management company. And then financing. You need to know your financing options before you buy. Of course, having the financing options for actually doing the acquisition, you're typically going to be using private funds or hard money company, but you need to know your refinance options. Are you going to go conventional? Are you going to do it with a non-QM investment loan or a local lender, like a portfolio loan? So you need to know your options, you need to know your credit score, you need to know how the banker is going to be reviewing your situation, get pre-approvals and all that before you start, because the last thing you want to do is get stuck in a short-term loan, you're not able to get out of it, and put yourself in a bad situation. Accounting. Do not do your own accounting. If you're not a CPA, if you don't have a degree in accounting and finance, don't do your own books. Don't do your own accounting. Hire someone else to do that. You can, as far as bookkeeping, $30 to $50 an hour in most marketplaces. 30, 50 bucks an hour can get that taken care of. And it doesn't take a lot of hours to manage 1 or 2 or 10 or so rental properties. It doesn't take a lot. Hire someone else to do that. You've got more important things to do. More importantly, if you screw it up, it's going to cost you more in the end. This is especially true on the tax return side. Don't do your own taxes. Don't try to figure it out on TurboTax. Hire a CPA that knows about real estate investments. They're going to pay for themselves significantly by not only doing it right and preventing issues on the back end, but also finding a lot of savings, because there's a lot of ways that rental properties can be either deferred taxes or be no taxes, at least while you hold them. So check with professionals, work with them. Don't try to do it on your own. And then escrow. You've got to escrow for capital expenditures and vacancy. You will have them. Absolutely will have them. You're not going to get lucky and pretend that a tenant's going to stay there for 5 years and they'll be squeaky clean whenever they leave. It's just not going to happen, regardless of how well you know them or if they're related. Escrow for those expenses, because you may be able to absorb 1 or 2 properties where issues come up, but say 5 within a few months. Like you have several vacancies or a couple roofs need to be replaced. You don't want to be forking that money out of your pocket and scrounging to find those funds. And if you can't, then just watching your asset deteriorate. You need to have the funds in an escrow account ready to go. Preferably an escrow account that's away, maybe at a separate bank than your main operating account, so you don't see it and you're not tempted to use those funds. And lastly, reinvest. So when we had our properties and we sold them using the sold flip strategy, we didn't go on a month-long vacation or buy a $100,000 car with cash or this huge house and have fun and make it rain with all the money. We did enjoy it. We did treat ourselves to something nice, but we invested like 99% of it back into the business, buying more property. That's the only way that you're able to exponentially increase your returns over time, is if you reinvest. If you spend everything that you earn, you're going to be on a hamster wheel. Just like the job, you're going to be on a hamster wheel and never get out, and you're going to look back and wish that, hey man, I wish I never sold those properties to begin with. So if that's tempting to you, it's actually better just to not sell. But if you can be diligent and you can sell and responsibly reinvest those funds back into other income producing assets, the returns are just staggering over time. Other than that, I hope this got you excited to invest in real estate and also invest in rental properties. This should show you that it's simple to do. Like retiring a millionaire is sometimes can seem very far and distant, but it's not that difficult, especially if you have a simple, clear system or plan of action to use. Hope you got a lot out of the ultimate guide to building wealth and passive income in real estate. like us, give us a thumbs up, or if you hated this video, a thumbs down, and leave a comment below. Let us know what you thought, any key takeaways you got out of this. Feel free to share it with your friends. Also, subscribe to our channel, click the little bell. That'll keep you updated on other great content that we have coming out. Find us on Facebook, Instagram, and always you can reach out to us or connect with us on our website, www.rehacking.com. That's rehacking.com.